So let us go to section 43B. Now what exactly is section 43B? It is a deduction on payment basis. We had various sections where we given a reference to section 43B, like in contribution to funds we've done that. We've done that in interest on loan. We've also done that in bonus and commission. So my friends, now is the time where we'll go into the depths of 43B. Very, very simple. And I'll also, with the help of an illustration, clear all concepts. Now understand what 43B says. It talks about business expenditure. So when expenditure is incurred in the business, the income tax wants that certain expenditure has to be paid as soon as possible. And there are 6 such expenditures which income tax intends that they should be paid as soon as possible. And those 6 expenditures are nothing but we've summarized it in a code word, and the code word here is CT bill. So we've got the acronym or the mnemonic of CT bill, which covers those 6 expenditures which the government wants that it should be paid as soon as possible. However, any other business expenditure which is not CT bill, do you think it should be allowed as deduction? And if you are thinking no, then I should shoot you with a bazooka, because it is other business expenditure. Since it is connected to the business, it has to be allowed. But this expenditure will be allowed on due basis. What we mean by due basis is, if it is connected to the current year, it will be allowed in the current year, whether paid or outstanding. So as far as any other business expenditure is concerned, that could even be allowed on due basis, whether paid or outstanding. But my friends, as far as CT bill is concerned, the government, I told you, prioritizes it for payment purpose, and it puts a condition that this expenditure must be actually paid. If you want the deduction, you must actually pay it, and pay it up to which date? Pay it up to the ITR due date. So if you are the businessman, whichever ITR due date applies to you, it could be the end of July, September, November, whatever ITR due date applies to you, you need to pay off this CT bill up to the relevant ITR due date. Only then in the year of expenditure can you claim the deduction. So if I am talking of 1920, I incur some CT bill, I should pay it off before the ITR due date of 1920, then only I can get the deduction in 1920. You'll say, sir, what if we don't pay? Then you won't get the deduction. What if we pay it in the next year, after the ITR due date? Then in the next year you'll get the deduction. So government intends that, look, the deduction will be given for these expenses only if you actually pay it. And if you want in the current year's assessment, if you want the deduction, then you have to pay it up to the current year's ITR due date. If not, the deduction will be allowed in the year of payment if you pay it after the ITR due date. Clear? So if it is paid up to the ITR due date, allowed in the year of expenditure, the year of expenditure becomes the year of deduction. And if you pay it after the ITR due date, then in the year of expenditure it will not be allowed, but in the year of payment it will be allowed. Now very soon I'll explain this entire thing to you with the help of an example, so kindly stay tuned. So let us now go to an example. Let's see the example very quickly. Okay, here we go. Let us say our PY is 1920. We've got our PY. Let's say the PY is 1920, and 1920 is bound by the dates 1st April 2019 and it ends on 31st March 2020. So we've got a date range from 1st April 19 to 31st March 2020. And in this period, let us say you incurred some CT bill. What is CT bill? Don't worry, I will explain all in detail to you the acronym of CT bill. So CT bill were these expenses you incurred in 1920 and you also paid them in 1920. Then my friends, it is very clear that you can claim the deduction for these expenses in the current PY itself, that is in PY 1920. Okay. Let us say you could not pay these in 1920. For some reason, you could not pay it in 1920. Then what income tax says is, we'll give you an extension. We'll give you an extension up to your ITR due date. What is your ITR due date? I say income tax, my ITR due date is 31st July 20. They say, okay, we'll give you an extension up to 31st July 2020. If you pay your CT bill any time up to 31st July 2020, then we will give you the deduction in the tax calculation of 1920 itself. They say, look, you could not pay till 31st March 20. Don't worry, we'll give you an extension up to your ITR due date. And if you pay the CT bill of 1920 any time up to your ITR due date for 1920, like in my example, I've taken 31st July 2020 as the ITR due date, even though it has gone beyond your PY, even though it has gone beyond the PY, beyond the current year's end, still you take the deduction in the year 1920 itself, because your tax finalization of 1920 will be done on 31st July 2020 in this example. So if you could not pay it by the end of the current year, don't worry, we still give you an extended time up to the ITR due date. And if this expenditure of 1920, the CT bill, was paid up to the ITR due date of 1920, then you will get a deduction in the tax calculation of 1920 itself. So think of this as a grace period allowed so that you can pay off these expenses and take the deduction in the current year itself. Okay. But my friends, if you do not pay up to the ITR due date, then what happens? Let us say I paid beyond my relevant ITR due date. In this example, I have taken 31st July 20, but it is different for different assessees. So whatever ITR due date is applicable to you, if you pay up to that due date, then in the current PY calculation, take the deduction. But what if you pay after this ITR due date? Then what? Then my friends, in this case, in the year of expenditure, you cannot get this deduction. In this example, let us say I paid the CT bill on 1st August 2020. My due date was 31st July 20, but I paid it on 1st August 20. Then in the 1920 assessment, I will not get a deduction for these expenses. If I pay my CT bill on 1st August 2020, then in the 1920 tax calculation, I cannot get a deduction for this CT bill. But since I paid it, the important thing is you have to pay it. Since I paid it, I can get a deduction in the 2021 PY calculation. So in the assessment of PY 2021, I could still claim this as deduction. So it's a simple model of the story that if you pay up to the ITR due date, in the year of expenditure itself you get the deduction. But if you pay it after ITR due date, then in the year of expenditure you cannot claim the deduction. In the year of payment, you can claim the deduction. So like if you pay your CT bill after the ITR due date in this example, in 1920 you cannot claim the deduction, but in 2021 you can claim the deduction. Clear? So this was very, very simple. Now the burning question, you've been saying CT bill, CT bill, CT bill, CT bill throughout. What the bloody hell is CT bill? Don't worry friends, I'll tell you, don't fear. Vinayak is here, so I'll be telling you each and every small thing. What exactly is CT bill? And you already know this. I just have to remind you. First, C for contribution to approved funds. Contribution to approved funds, which are the approved funds, SPF, RPF, ASAF, which we've seen under section 3614, 4A5, correct? These funds have to be paid up to the ITR due date. So under 3614, 4A5, these funds have to be paid up to the ITR due date. That was your contribution to funds, correct? Now, one question in your mind will be that, look sir, what if we make a contribution to unapproved funds? We have already seen that a contribution to unapproved funds is never ever allowed. It's a non-statutory fund. So 40A9 says that a contribution to unapproved funds will never ever be allowed. But if you make a contribution to an approved fund like RPF, like a recognized provident fund, then yes, it will be allowed only if you pay it up to the ITR due date. So if the CT bill is paid up to the ITR due date, you take the deduction. If not paid up to the ITR due date, then when you actually pay it in that particular year, you take the deduction. T4, taxes related to the business, such as GST. GST is a tax related to the business. So you'll get a deduction for the GST only if you pay it up to the ITR due date. What if you do not pay it in up to the ITR due date? Then in the current year you will not get a deduction, but in the future year of payment you'll get a deduction. Year of expenditure, no deduction. Year of payment, you'll get a deduction. So your GST has to be paid up to the ITR due date. Another example of taxes related to the business is customs duty. If you pay your customs duty up to the ITR due date, then in the year of expenditure, you can get the deduction. What if you pay it after the ITR due date? Then in the year of expenditure, no deduction. In the year of payment, you will get a deduction. Okay. Now, what if you pay your income tax up to the ITR due date? Income tax is never allowed. So, income tax, you will not get a deduction even if you pay it up to the ITR due date. It is a personal tax of the assessee and it is specifically disallowed under 40A. So even if you pay your income tax up to the ITR due date, you cannot get a deduction for it. B, bonus and commission of staff. Now this we've already seen that it is subject to 43B, means this also has to be paid up to the ITR due date. The interest on a business loan taken from a PFI, public financial institution, PFI, public financial institution. This is general knowledge. PFI, public financial institution. SFC, state financial corporation. SFC, state financial corporation. SIIC, State Industrial Investment Corporation. SIIC, State Industrial Investment Corporation, and scheduled banks. So if you're paying this in the PFI, SFC, SIIC and scheduled banks, then you will get your deduction only if you pay it up to the ITR due date. If the interest is related to any other institution besides these four, then it will be allowed on due basis. CT bill will not apply because it will fall in other business expenditure. So if you've taken a loan from me for the purpose of business, and even if you do not pay me up to the ITR due date, you can still get the deduction on due basis because I am not a PFI, I am not an SFC, I am not a SIIC, I am not a scheduled bank. But if you take a loan from the Bank of India, which is a scheduled bank, and do not pay it up to the ITR due date, then you will not get a deduction in the year of expenditure. The year in which you actually make payment, let's say 3 years later you make this payment, then you will get a deduction 3 years later. Next, very important, this is the amendment. The payment to the Indian Railways for use of railway assets. Like for example, there are hoardings which we put on railway bridges. there are premises on the station like shops etc. on the station, which area that those premises or that area we take from the railway on rent. Now if we take assets from the railway on rent, then we have to make sure that we pay the railways the rent, whatever the lease rent, the space rent, whatever, up to the ITR due date. And if we do not pay the railways their payment up to the ITR due date, then we will not get the deduction. So businessmen who are using the assets of the Indian Railways should make sure that they pay the Indian Railways the relevant amount up to the ITR due date. If you pay it after the ITR due date, then that particular year you can get the deduction. But if you want a deduction in the year of expenditure, you have to make sure that you make the payment up to the ITR due date. And the last is leave encashment of employees, the leave salary which you pay to the employees. This you should make sure you pay up to the ITR due date. So what is CT bill? Remember the first word: contribution, taxes, bonus, interest, Indian Railways, and the leave encashment. So contribution to funds, taxes related to the business, bonus and commission of staff, interest on a business loan taken from a PFI, SFC, SIC and a scheduled bank, payment to the Indian Railways for use of railway assets, and leave encashment of employees. These should be paid up to the ITR due date if you wish to claim the deduction. Clear? So I hope that does it for your CT bill.